What's up, everyone? Welcome back to the program. We were promised a Black Monday, but it seems we are having maybe an Orange Monday. The markets are down, but not as much as what people expected. And perhaps this is due to the fact that the markets were dropping so much last week at the end of the week that we are due for a relief rally. However, in the rest of the world, as you can see, markets were down massively, especially in Asia. Hong Kong down minus 13%, Taiwan almost 10%, Japan almost 10%, also Singapore minus 8, Italy minus 8.4, etc. You can see all the list here. So basically what happened is that the rest of the world is playing catch up with the US markets dropping on a Friday. And now today, the US markets, they're still down, but not as much as the rest of the world. And everybody is caught up to sort of the new status quo, but we're having news now that perhaps this tariff war is going to keep on going, with Trump saying that, they're thinking about adding some more tariffs to China in retaliation to the Chinese retaliation of the original retaliation of the tariffs. It doesn't stop, and it's going to keep on going until somebody gives in. But another news here, we have a closed board meeting scheduled for the Fed today. And perhaps we're going to see the Fed is going to have to act. They might do an emergency meeting and emergency cuts. We're going to have to see. Of course, it's going to depend on what happens now in the next few days. But if they are doing that, perhaps they know something we don't know. Perhaps they have been talking to the White House and they are aware that this is going to just escalate, and that essentially we're not going to see the end of this tariff war happening anytime soon. But let's jump in now and let's have a look here at the markets. As you can see here, the Dow minus 1.8, S&P minus 1.27, NASDAQ minus, it's moving fast, 0.5%, something like that. The DXY 103 slightly up. The VIX is still going back up at 50 now. And Bitcoin at 78, it dropped a little further down earlier, but now it's regaining some of the losses. Ethereum 1,500, and as you can see, the yields are up across the board. The 10-year at 4.1, and gold is now back down under $3,000. Silver under $30. Let's have a look here at the SPY, and let's have a look at what happened earlier today. As you can see, we gapped down and open below the close quite substantially. We're down almost 5% from Friday's close, but right away reversal. That was what you could expect, for a relief rally, sort of gap down and reversed, and that's what happened here. And then the news came that we can expect now some retaliation to the retaliation. So now let's have a look at what the talking heads are saying.
Anthony Chan is the former JP Morgan Chase chief economist and joins me now. If this stretches on for months, does that mean we're in for a recession?
There's no question that if this is prolonged, that we're going to see bad things happening. I mean, at this point, even my two talking pet parrots have increased their probability of a recession. But we can't start forecasting a recession because of what has happened in just 5 or 6 days. So I think there's still room for compromise. I think there's room for negotiation. If we get any of that from either side, from countries in the United States, then I think we can avoid a recession. So I still remain cautiously optimistic that we can avoid a recession. But you're absolutely spot on, Stuart. If this is prolonged, we will get a recession.
Okay, Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Trump's trade war wiping trillions of dollars in value from these markets in just a few days. We will assess the damage now, debate what is next. With the investment committee, of course, joining me for the hour today, Joe Terranova, Brian Belsky, Jim Lebenthal. Also with us on set today at Post 9, senior market commentator Mike Santoli. We will show you the markets. We have had, as you probably know by now, the biggest intraday move since early 2020, from bottom to top, 8%. It's been extraordinary. It's been volatile. It's changing by the minute. So continue to watch the majors, and we'll continue to bring you up to date on what is happening. Joe, what's on your mind?
Treacherous, that's the word. The environment of today is an awful environment. It's an awful environment for an investor. It's an awful environment for anyone that's trying to trade this market. The last couple of days, yes, there were opportunities as it relates to trading. There are certainly opportunities for long-term investors who do not believe that what the future will look like is going to look like something we saw in the 2000s when we had a lost decade. But what we are seeing today, when you have that 7% swing, when you've had the deleveraging that you've had over the last several days, what happens after that deleveraging? A lot of hedge funds, a lot of institutional speculators, they step to the sidelines. And what you're greeted with is a type of a market environment where you have today where you think you potentially get an all-clear signal, and then you're just whipsawing all over the place. So what do you do in that environment? I think you really have to study how much risk you have in equities and bonds and the totality of your portfolio. And if you're beyond the boundaries of where your comfort level is, I think you have to retreat on that, because you cannot have strong conviction about either direction right now, given this treacherous environment.
All right. You make the claim that this is not due to fundamentals. I would make the argument that it is everything to do with fundamentals. Forget about the technical trading of levels here and there, averages, blah, blah, blah. This is obviously about the market sensing a recession and trying to right-price itself for the recession that many now see as a higher probability. Many firms are obviously taking up their expectations of that. If you think that earnings are going to have to come down, which they will in a recession, and that the multiple will have to come down, which it will, then that is purely based on fundamental trading, not on anything else. That's what the market's trying to go through. Don't you agree?
Okay, so stocks lead earnings, which lead the economy. The stock market's telling you that we're probably going to have some sort of a slowdown and or a recession. Remember, when the recession, the Fed comes in and pumps in liquidity. The Fed pumps in liquidity. What are we going to do? We're going to buy stocks. So I think at some point we are going to have some sort of slowdown and the earnings are going to go down. We'll adjust our targets when we start to see some substantive proof of that.
What do you mean?
No, hold on a second. What's happening? Do you think that this rhetoric and change in tune and fake news and tariff stuff, do you think that has anything to do with how companies are going to be earning their money or how they're looking at going forward, how to model their company? How can they change on a daily or weekly basis when we don't know what we don't know?
You're telling me that companies haven't already changed their expectations for the kind of business and spending and investment that they're going to do? They all have.
Do you think
they all have?
Do you think the membership process in Costco has changed? Do you believe the way that the operating system runs Apple has changed? Do you believe that the internet machine at Google has changed? Do you believe that how Netflix and the way that they run their business has changed? No, the answer is no. Now, how they model that, how they grow that, how they operate that, yes, we know that, and that is going to change. And we will change our numbers accordingly when we see those real numbers, Scott. So I think from a longer-term perspective, we are investors. We're not going to react to today or last week or what Trump's going to say in 30 seconds. We don't know that, because that's not fundamental. What Trump is saying is not fundamental with respect to his reaction, and how we're reacting is not fundamental. But the markets are what the markets are, and it's not different this time. It's not different this time. And the way that the markets react to these types of things and how they flush this out is exactly how they're going to flush it out.
Had a almost willingness by a president of the United States to send the market down by $11 trillion worth of value ever.
And that's why I said unfortunate. As an investor, and as we talk, and we have to answer to our clients, Scott, because we, unlike other people, We actually run real live money, and it's been a really humbling time. This is not time for pride. Pride brings disgrace, and humility generates wisdom. Now's the time for humility, and it's been a tough
You don't
3 or
sound
4
humble.
days. What do you mean I don't sound humble?
Your tone, I mean, the strength of your voice sounds like there's humility in it, but your narrative doesn't sound humble at all. It sounds like refusing to see the facts in front of you.
No, we don't know exactly what the facts are, quite frankly. When
Do you think that the earnings numbers at the high are realistic?
No,
you
I don't
staying?
think they're-
What are you staying with? What are you at? The $290, $300?
No, I'm at 275.
And what multiple you put on 275?
Well, 270. Well, again, markets don't run off multiples versus earnings. Okay, that's not the way that that's an academic practice. It works with respect to the 500 stocks in the S&P 500 and what they're growing. That's too simplistic side of things. But if you take a look at where we think normalcy is, it's a high teen to low 20s multiple. That's where we are from a longer term perspective.
That's not a recession multiple.
Who says we're going to a recession?
That's not a slowdown. That's not even. It's just not even realistic for even if you get growth. Right now, it doesn't look like you're going to get much, does it?
Do you know that?
We're going to pay 20. Okay, so 20 times earnings makes sense to you right now. That makes sense.
I think 20 times earnings, given the fact of the consistency of the earnings backdrop, the United States longer term, yes, it makes sense, especially considering where I actually do think that money's going to come back to the U.S. over the next year or two. I really do. And so let's get through this unfortunate behavior and move on from here. And I'm sorry. I'm sorry if you don't think I'm humble, because I'm actually quite humble, Scott. And you would know this if you'd actually sit with our clients and talk to us about how we've been in terms of longer term. And we have a track record that we're going to sit with in terms of calling markets and making people money, and we stand behind that.
We have some commentary right now from Larry Fink, who obviously runs BlackRock. He is speaking right now at the Economic Club of New York. Leslie Picker has the latest for us. Les, what's he saying?
Hey, Scott, yeah, he was asked first and foremost, there's a lot of history in the building of the Economic Club of New York. How would you characterize this moment in American history? And he was pretty sanguine. He said it's no different than anything else. We're fine. And then he said in the long run, he would say this is actually more of a buying opportunity than a selling opportunity, noting that doesn't mean we can't fall another 20% from here too. But he does believe, this is a direct quote, that over the long run, the vitality of the United States will persist. That said, he noted that they haven't had this many client conversations with the BlackRock community since March of 2020 in the heart of COVID. So it sounds like the phone's really ringing off the hook to get some clarity here. But at least from his standpoint, he says, even though the market could fall another 20% from here, that in the long run, he sees this as more of a buying opportunity than a selling opportunity. Scott.
Leslie, thank you very much. Leslie.
Yes, of course. And, that makes total sense. And the question is, how low can we go? And, of course, whenever this thing gets resolved, and it will get resolved eventually, because we're not going to move into a world where no one trades with anyone. We're dealing with a moment where there is a reshuffling in global trade, and there's going to be new trading partners that are going to be created, and there's going to be old trading partners that are going to be put to the side. And, you can bet that China is going to be that partner that's going to be put to the side for many reasons. For diplomatic reasons, for geopolitical reasons, for sort of militaristic reasons, and this is a major reshuffling of the world economy. But it doesn't mean that globalization is over, as Keir Starmer is going to be saying today, or maybe he has already said it. But this idea that the old order is over. No, it's going to be slightly different. It's going to be different, trading partners that are going to do it. But of course, things are going to continue. And, of course, in the long term, then this market is going to keep on going up. And if anything, what's happening now, it's actually going to make the U.S. a more central part, a re-centralization of the world economy around the United States. And this is a moment where the United States is trying to identify friends and foes in the world economy. And the time now is for the friends to come to the negotiation table with the U.S. and find a way to resolve these tariffs and perhaps drop trading barriers on their own to get relief on the tariff side from the U.S. and for the foes to be identified, and the people who are not willing to play the game, at least on a fair basis, well, they're going to be sort of put out of this trade, this global trade with the U.S. By the means of tariffs.
I found some interesting stuff in Jamie Dimon's letter this morning because he addresses a couple of issues. He talks about our relationship with our allies and why it's so important. He also addresses China specifically, and he says, well over a decade ago, both business and government should have focused on certain problems with China, unfair trade across multiple dimensions, and our reliance on China for critical national security-related components. But he goes on to say, whether you view China as a competitor or a potential adversary, we should work with our allies to firmly negotiate an ongoing relationship. However this shakes out, you can't get away from China. That's what he's trying to say. But he's saying reform needs to happen.
Well, here's the thing. He may have talked about it, 10 years ago, but COVID was a prime example of why we need to wake up. It was ridiculous, the position that we had. And they talk about a supply chain issue, the breakdown in the supply chain. Oh, it wasn't a breakdown in supply chain. We imported a bunch of stuff from China. The containers sat over here because they didn't reciprocate. They didn't bring a lot of things from us to them. China's in trouble right now. China has an economy that is in a lot of trouble. Xi is in more trouble than he's ever been in politically. The stakes are higher than ever that they would invade Taiwan. I didn't believe it would happen under a Trump administration, but I would personally think there's a 50-50 chance because that's what a desperate person does, leader. Say, okay, if we shift the focus, nationalism will swell. And plus they may think they have us over a barrel. To your point about that, ISI Evercore came out last week and said China specifically announced those to hurt our stock market. And of course, China then said, hey, the markets have spoken. Right. And we just have to be very careful. They are an adversary. They are a competitor. And if you know history, at some point, they want to take Taiwan. They will take Taiwan. The Belt and Road Initiative was a brilliant move on their part. We slept through the whole thing. They have their tentacles all over the world. Obviously, they dominate in rare earths and things like that. And we're behind in a lot of areas. So we really, really have to look at them in a way that the least we're dependent on China, the better.
Well, one thing I just wanted to point out, just to kind of lay out the big figures, just in the last 2 days, this is not including the sell-off today, the U.S. markets have lost this is just the S&P, not the Wilshire 5000, $8 trillion in market value to fix a $1 trillion trade deficit. That math ain't mathin' to a lot of people. That's a lot of pain for not enough gain.
That's a good point.
Well, maybe then it's...
But it's really not about the money, and it's not about the money of the trade deficit. It's about the hollowing of the U.S. economy and the industrial and manufacturing sectors. It is more than actually the money. It's really a matter of national security because, let's say we do nothing and we just keep on going and we let China continue to build their infrastructure, their industry, their manufacturing, and continue to build up their military, then we wake up, 10 or 15 years from now, and we have no industry, no manufacturing, no military. We're completely bankrupt, and we're totally unable to do anything while China becomes the world superpower, and then we can't react. We're just drowning in debt, and then all the revenue that the government can make just solely goes into paying the debt. And if you go down this route, then the country is over. You will never recover from that position. So, of course, these tariffs, this is not about just a trade deficit. The trade deficit is more a good reason for them to do that, so that they don't get into this frontal confrontation, almost a military confrontation with China. They're giving a reason, saying, oh, well, you see this thing that can never be corrected. That is the reason why we are doing that. But of course, China knows and the U.S. knows that this is not really the reason. The reason is that, the U.S. wants to react before China becomes the dominant superpower in the world. And right now, the U.S. is in that position, and they're not going to go down without a fight. Okay, so we can see today it's absolute panic everywhere on the set of CNBC, in the market, all around the place. Everybody, it seems that people don't know what to do. They don't know what to think. They don't know what the future is. And there is a lot of panic. And the panic is not because of the drop in the market. People over the weekend were saying stuff. We're saying, oh, we're going to be down 10%. We're going to be down 15%. It's going to be Black Monday. It's going to be horrible. And actually, what turned out to be, we gapped down and then we reversed on some fake news, and now the fake news has been unveiled as fake news, and actually what we get is even worse news. The threat of additional 50% tariffs being put on China, perhaps on April 9th, if China doesn't back down with their own tariffs. And the market, ever since that news, basically is muted. So really, it's not a problem of the drop in the market that is making everybody panic. It's really the uncertainty as to what is going to happen next. And of course, we don't know that. But, make sure you're subscribed to this channel so that you don't miss our next episode. We're going to follow this tariff saga all the way until the end. And if you don't mind, just leave a like in this video. And I will see all of you on the next one.
Hit me with that like, and sub to the channel. Hit me with that like, and click the effing bell. Click that bit, alright. The algo recommends, for she go like. The algo knows you well. Hit me with that like, subscribe to the channel. Hit me with that like, and click the effing bell.